What if I told you that I could get you an interest rate 3% below what the current market interest rate is at no cost to you? Would you want to learn about that? Well, I can, and I will tell you all about it. We have 2 loan products right now that we are working with as a real estate team that are helping our clients get 3% below. Our interest rates are currently at 7%, and we're getting our clients interest rates in the 4s. I'd love to tell you all about it and the 2 loan products we're using, the pros and cons of each, and which might be a better fit for you. My name is John Glutch. I'm the team leader of the Glutch Group. We've got real estate teams in San Diego, Las Vegas, and Phoenix, and we sell hundreds of homes every year. And many of those homes have loans attached to them, right? They're not cash purchases. So we're in the thick of this. And interest rates were like 3% not long ago. And now, as of the date of this recording, they're at 7%. That's a gigantic shift. And we've been busy working on solutions for our clients to help them stomach that. And we found some really great ones. So let me talk you through the high level and give you some recommendations. First of all, is a 3-2-1 buy down. And this is a loan product that allows you to artificially lower the interest rate for the first, second, and third year that you own the property. And here's how it works. There's an upfront payment, and that upfront payment pays down the payment for those years. So it pays it down to a 3% discount your first year. So for our example, let's say it's 7% right now. Your first year is going to be 4%. Your second year, it's going to go up 1 to 5%. Your third year, it's going to go up 1 to 6%. And then your fourth year, it's going to be at the 7% rate. So for 3 years, you're getting the benefit of that discount for an upfront payment. But we have some secrets as to how to avoid you actually paying that fee. I'll talk about those in a minute. Let me give you some specifics on those numbers. So let's say it's a $500,000 loan. I'm just going to give you these figures in principal and interest. So I'm not factoring in taxes and insurance and all that. This is just what your payment's going to be. So on a $500,000 loan at 7%, year 4, so like what your payment should be at 7%, is going to be $3,327. Now, that's a little painful, right? That's a relatively high interest rate compared to what we were getting years ago. So this buy down buys your payment all the way down in year 1 to $2,684. That's a gigantic difference, $643 difference per month for the first year. The second year, your payment's going to go up to $2,684. The third year, $2,684. The third year, $2,998. And then the fourth year, again, is $3,327. So your payments are ratcheting up slowly but surely. So this is a fantastic way to get your payment to be lower initially, but then of course it ratchets up. So why would you do this, right? You're eventually the payment's going to be what it's going to be. What's the benefit here? Well, we're betting on the fact that interest rates are going to get better. And then at some point in the next 3 years, you're going to be able to refinance out of this into a better loan product. And the likelihood is very, very strong that interest rates will get better, because in every recession we've had as a country, the interest rates on loans have gone down during those recessions. And there's all kind of reasons why that happens. But let's just say, for the simplicity of this video, that it's probably going to happen. It would be exceptionally unlikely and unusual for interest rates to not go down during a recession. And everyone, all the talking heads, the big voices, the smart people who figure this stuff out say we are either in a recession or we're headed toward one very quickly. I think that's extremely likely. So if you're like me and you're betting that we are going to have a recession, and if you're like me and you're betting that during that recession, like every other time, interest rates have gone down, this isn't a bad idea, because this gets you into a nice low payment for a couple years while you have this beautiful new home that you purchased, right? And you just refinance out. Now, of course, there's a chance that that doesn't happen and you eventually get to the full payment, right? Well, the good news is the underwriter is going to, meaning the person at the bank who decides you can afford this loan, they're going to underwrite you at the full payment. They're not, this isn't 2005 when it's just like, well, you might be able to afford this. Let's give you the loan. No, you're going to have to be able to afford the full payment. They're going to make sure that all your ratios work at that big full payment, right? You got to be able to know that worst case scenario, you're sticking with this loan. The likelihood though, of course, that it does go down. So that's one, pro is that, of course, you get a lower payment on the first year, second year, third year. That's fantastic. Let's say you do refinance. Well, all the money that you paid in on the front end, remember I mentioned there's that upfront payment. In this case, that upfront payment would be $22,927. So it would cost you roughly $23,000 to do this. But again, I'll tell you how you're going to avoid paying that in a minute. That $23,000, let's say you refinance year 1. Well, that money doesn't just disappear. You can roll that forward into the refinance. You get the money back. You don't lose it. There's some nuance there, but just know that that money doesn't get lost if you do refinance. And then, again, the pro is, of course, that there's a likely opportunity for you to refi. Now, how do you avoid paying that money? Well, the real estate market right now is pretty slow. not every realtor is telling you what I'm telling you, which is, hey, we have options for you to get lower rates. And because rates are so high, people are freaking out and they're waiting. They're waiting for interest rates to go down to buy a house. So you don't have much competition, which means you as a buyer waltz on into any house that happens to be for sale. And you're kind of a big deal now. You know, a year ago, they didn't have time of day for you because they had 20 offers. Well, now you're kind of a big deal. And so what can you do? Ask for the seller to pay that $22,000. Absolutely, that can happen. We are seeing this much more common now. This is a seller concession, right? And this used to happen. I've been doing this for like 20 years, and for many years, this was common. The seller would pay some of the fees, whether it was the lender fees or the commissions or the title fees or the whatever. And that's much more possible now because you don't have near as much competition. So it is not unlikely at all that we can get the seller to pay that fee for you. Of course, that depends on how popular the property is and how they price it, right? If it's a gorgeous remodeled house that they price 10% under market, you're going to be fighting with other people. But that's not happening very often right now. More often we're seeing, you walk in, it's the dust is blowing by, right? There's the tumbleweed and all that. Okay, so now that's a nice spot for you to be able to negotiate, get yourself a buy down that you didn't pay for. Okay, what are the cons? Of course, interest rates might not get better. You might not be able to refinance. You could potentially, if home values go down and you're trying to refinance, that's going to make it tougher to refinance. You're in theory paying more for the house because you've got the upfront fee that the seller's paying for, right? Yes, they're paying for it, but could you have got a little better deal? Possibly, right? So there are some downsides. And of course, that stepped up payment, you've got to be ready for. You got to be able to make that increased payment as it goes up. So there are some downsides to this product, but I really, really like it as an option. It's absolutely worth taking a look at. The second option, I like in general, I like better if it happens to be available. Sometimes it is, sometimes it isn't. And that is an adjustable rate mortgage. So if you are either not going to stay in the house for very long, or you are willing to take the bet that interest rates will get better, an adjustable rate mortgage might be for you. I happen to have an adjustable rate mortgage. And here's how those work. Is there's two numbers in front of, they're called ARMs, adjustable rate mortgage, and there's two numbers in front of those typically. And the first number is how long your rate is fixed. So there's a 3-1 ARM or a 5-1 ARM or a 7-1 ARM. There's all these different options. The first number, 3, 5, or 7 in those examples, is how long the rate is fixed. So whatever your rate is today, and it's depending on the market, these vary. You have to check with your lender and compare these two products. But right now, we are seeing ARMs about 3% lower than a conventional traditional mortgage with a fixed rate payment. So about 3% down. So in our example, instead of 7, it's 4. That 4 on like a 3-1 ARM is going to be stick at 4 for 3 years. And then it's going to adjust. The 1 is how often it adjusts. So every year thereafter, it will adjust. And every ARM has a maximum. It can't adjust 10% in a year. They all have their own maximums for how much they can adjust, typically 1% per year. And so you're betting that in a 3-1 ARM, for example, that sometime, because you've got your 3 years at 4%, then your 4th year goes up to 5 in theory, the next year goes up to 6, and actually, you're betting on about 6-7 years that you're going to come out ahead, that rates will go down, you'll be able to refinance into a better product. And there's varying lengths and degrees of these. And so the nice thing about these is there is no upfront cost. So that $20,000, $23,000 payment that you would use on a buy down, that goes away. That doesn't exist, which is fantastic. So that's a real pro of this. The downside is the rate could get higher than on a buy down. So if you are stuck with this loan for whatever reason, because you can't refinance into a lower payment, or your equity goes down and you can't refinance, the possibility of it getting higher than 7 is very real. Whereas with the 3-2-1 buy down, it's never going to get higher than the current rate. So these ARMs are a little bit more risky in that the upside of the rate could be higher, but the nice part of it is there's just not that upfront fee. So I like ARMs better if you really believe you're going to be able to get an interest rate lower in the future. I like these a little bit better. Or if you're not going to live in the house for 10 years, you could just do the math. And this gets, particular, right? It's all about you and your circumstances. And that's where you really need a trusted advisor. You need a great real estate agent, a great lender. And so if you are interested in comparing these two products and seeing which one might be a better fit for you, or maybe a conventional product with a fixed rate is better for you, let us know. Reach out. We can help advise you, give you all the numbers, exactly what they would be today. And again, one of the challenges of these ARMs is sometimes they're not very good. The interest rate is only maybe 1% lower than market rate. Well, okay, that's not really worth the risk. So it's very market dependent. And oftentimes we see Certain banks have these and certain banks don't. So credit unions more often than not have the best ARM rates, but it's going to take connecting with us or another professional in your area who really knows the loan products, because we have certain lenders we use for certain products and others ones we use for stuff like ARMs or buy downs. And we've really worked hard to shop the whole marketplace and find who are the best possible people. And that changes like literally day to day, who has what kind of availability. So reach out to us. We would love to help you solve your specific loan problems and answer your questions for you and make sure that you have the best possible advice moving forward. So hope this helps you to wrap your head around how you can, as a buyer, can have a real advantage in this marketplace by stepping in, purchasing properties, and you have a much better interest rate than all the other people bidding. And that gives you a real competitive advantage to go out and get yourself a fantastic deal. Hope this helped. Reach out. We would be happy to talk you through your particular situation. Bye-bye.